Hello, and welcome to this quarter's investment briefing, brought to you by Gemini Asset Management. It's been a very busy quarter, and we've been faced with highly changeable market conditions from one month to the next. Most recently, in September, with a flurry of fiscal policy changes in the UK, which caused considerable market volatility. Given the quickly changeable nature of these markets, we'll just try and focus on three topics, with the caveat that everything covered in this video is up to the date of the 30th of September 2022. First, we'll dive right into the market performance over the quarter. Chart 1 on screen now shows the performance of some major equity markets through quarter 2 and quarter 3 of 2022. As you can see, it's been a mixed bag with considerable volatility as markets suffered through most of quarter 2, then bounced strongly throughout quarter 3, only to then give up almost all of the recovery bounce later on in quarter 3. There's many reasons for this, but they tend to be focused around whether markets are expecting central banks and government policymakers to focus on inflation or economic growth, or more precisely, the lack of economic growth and potential recessions. Indices like the S&P 500, which have considerable weights to growthy sectors such as tech, tend to perform well in environments where interest rates are expected to fall. And interest rates typically are expected to fall when central banks and governments focus on the fighting off of recessions, as was the case at the time markets were bouncing throughout July and August of 2022. Indices like the FTSE All-Share, which have a greater sensitivity to economic growth and have larger weights in commodities and financial sectors, tend to perform well when economic growth prospects are expected to be positive. And they've typically outperformed during times central banks have focused on the idea of containing inflation. All this being said, a picture paints 1,000 words. And the volatility in markets throughout 2022 so far can be best summed up by the cartoon that's on screen now. Neither market driver, whether that be stubborn and high inflation or recessions, are positive from an economic viewpoint, but the expected actions of policymakers from central banks to governments on these two topics can have a considerable impact on how markets react. Which moves us on to our next topic, the new UK government and their mini budget. On Friday, the 23rd of September, the Chancellor Kwasi Kwarteng announced a whole raft of measures, from tax cuts to energy price freezes, to attempt to stimulate economic growth in the UK, citing desires of a 2.5% per year growth rate. The mini-budget was originally assumed to cost somewhere in the region of £45 billion, and this was something that alarmed institutional investors, and has led to one of the more startling groundings of flamboyant economic policy we've seen in years. Investors reacted so poorly to the announcement as the expansionary mini-budget comes at a time of considerable uncertainty surrounding economic growth and the stubbornness of inflation within the economy, leading to a clear conflict between the policies announced by the Chancellor and the stated goals of the Bank of England. The Bank of England's policies were specifically focused on inflation and designed to cool the economy, whereas the Chancellor's policies were focused on recessions and economic growth, and they were designed to hot up economic activity. So, in this maelstrom of policy making, and specifically as the Bank of England stated that it wouldn't be buying any more UK government debt, investors rightly asked the new government a question which most governments haven't been asked in years. How are you going to pay for this? Investors showed little confidence in the UK's economic prospects, and following the Chancellor's policy announcements, were expecting much more stubborn inflation in the UK, leading to the Bank of England raising interest rates even further than they had originally planned. UK government bonds understandably dipped on the announcement of the budget. Chart 2 on screen now shows the performance of both the 10-year and the 30-year UK government bonds, or gilts as they're known. As you can see, gilts were hit drastically in quarter 3 of 2022, and at one point, after the Chancellor's game-changing announcements, a 30-year government bond was 35% down on the quarter so far. Remember, this is long-term, developed country government debt, which is typically one of the most low volatility asset classes out there. Thankfully, for short-term market stability, the Bank of England then stepped in and, for want of a better phrase, saved the day. It essentially agreed to buy UK government bonds and then stabilise the market. Hence the dramatic bounce back in performance at the very end of the month. The conflicting goals and policy implications of a central bank aiming to tighten the belt and a government aiming to loosen it led to considerable volatility. But even though things have started off incredibly poorly for the new Chancellor, It's still too early to write off the new government's policies as a pure failure just yet. By the end of the quarter, we'd only have been 1 week into this experiment, and these things should be judged over an appropriate timescale before any definitive conclusions are drawn. The same can be said for using suitable time horizons in the world of investing too. Making snap judgments and acting drastically based on short-term noise may be a recipe for disaster for long-term investors. It's crucial to avoid falling into these traps of negative investor psychology. Things like reactively moving a diversified portfolio to cash after a localized dramatic event. The old adage that it's about time in the market, not timing the market, is repeated time and time again, as it remains one of the most important investment principles for long-term success when investing. Markets move in cycles, and there will inevitably be some difficult days, some poor years mixed into the great times of considerable long-term investment returns. Maintaining appropriate time horizons is crucial to avoiding potentially costly mistakes based on short-term noise, and I think that the image on screen now sums it up perfectly. We aim to remove the emotion out of investment decision making to enable us to make the most logical and consistent decisions for the given risk appetites of our clients, who are investing for the medium and long term. Often, during times of market instability, it can seem certain that markets can only be heading in one direction, downwards. But it can be a dangerous game trying to call tops or bottoms of markets. And it's still true that often the most positive days of investment returns are achieved just after the days of most negative performance. This whiplash effect of returns is typically due to market sell-offs being worsened by panic selling as the markets fall. Then markets may bounce a bit after the initial panic selling could have been deemed an overcorrection. Panic selling and missing these recovery bounces may have a considerable impact on the long-term investment returns. Just look at the COVID market crash of March 2020. Selling in March 2020 and listening to all the noise in the media could have seen an investor miss out on exceptionally strong bounce backs in markets throughout the rest of the year and through 2021. Finally, I think it's worth remembering that we're diversified portfolio investors, and the level of diversification across regions and asset classes in the portfolios have typically given an element of protection to the volatility created by individual market events. And this has been especially evident both during the COVID crash of 2020 and in the last week of September this year. Chart 3 on screen now shows how our GAM Risk 5 discretionary model performed relative to the FTSE All Share, shown in black, and UK government bonds, shown in red, over the last 5 years. As you can see, there's been times where our portfolio performed very differently to the two market indices. And even though UK government debt encountered stormy waters recently, this only makes up a portion of the portfolio, and the majority of the portfolio value has been driven by factors other than the UK asset exposures. As you can see, our GAM Risk 5 discretionary portfolio fell considerably less than the UK government bond sector over the last quarter, which again highlights the benefits of having a portfolio diversified by multiple asset classes and over different regions around the world. That's all from us here for today's video, but please feel free to get in contact and speak to your advisor to discuss any queries that you may have. We're always happy to help. All that's left to say is thank you very much for watching, and we'll see you again soon. Thank you.